What up, investors? Would you believe me if I told you Charles Schwab Corporation controls 7.38 trillion in client assets in one way or another? Boom. They do. So, what I'm going to talk about first is a little bit of an overview of the company. This one's been in the works for a while now. So, I'm going to give you some financial data, some performance data. I'm going to dive into the quarterly report a little bit to try to find out where their sources of revenue are and sources of income. And then I will try to determine the health and the likelihood that this company is going to be hit by this little sickness that's come about, diseasing all kinds of regional banks and trying to penetrate into the major banks out there, but not succeeding thus far. We're going to find out if this bank can catch the cold. First of all, I don't like their website. You know what? These damn exclamation mark things, I'm really not digging it. All right. When I use interactive brokers, they do the same crap. Okay. They put these warnings everywhere, yes or no answers to complete the trade. It takes me like 5 steps just to buy something. And every time I am hit with all these notifications everywhere, it's a little bit hard to move around. I do appreciate the simplicity when it comes to a broker. So, for that reason, I'm actually using Robinhood a lot more for simplicity's sake. And I use that example intentionally because although many people are comparing Charles Schwab to other banks, like US Bank, Citibank, videos that I've done before, I compare it more to a company like Robinhood. Why? Well, I'm glad you asked. Because Charles Schwab is a financier, a CEO who started the Charles Schwab Corporation, and he was the one who pioneered discount trading. Right? He was the first one to kind of take a big chunk out of the commission of people, try to popularize it a little bit, and he blew up. People fled to him because it was more efficient, right? He offered them a better deal. He liberalized, is that a word? I don't want to use democratized. Liberalized, made available to the masses, investing and a chance to live that investment, American dream. So he did well. And now he stands at the 210th richest man in the world, with a total of around $10 billion. Still a major shareholder in Charles Schwab Corporation, although not the CEO since 2008. So you can see the parallels there with Vlad, my countryman. Many of you didn't know this. I'm actually originally from Bulgaria, and Vlad Tenev is my countryman. No bias there, by the way. I started using Robinhood in 2015 before I even knew who the CEO was, and I really liked the app. And I only found out he's Bulgarian 5 years later. So I'm not biased or anything. I just like the company. Back on topic. We're going to look at Charles Schwab, first of all. We're going to do a little overview here of the price action where all the stories should start. The reason we're talking about Charles Schwab is this. This is the bank sickness contagion mark. All right. This bank has followed KRE very closely and has continued to drift down with the rest of the banks after the initial drop in devaluation, and has struggled to gain some ground ever since. Now, I want to find out whether this company is going to catch the same sickness that a lot of the regional banks caught? Is that a danger even if it does get diseased? And not only is the company going to go bankrupt, but is it also a good buy? Is it a good investment? So hopefully by the end of the video, I will present you with that answer. First, it's my favorite tab after this one. And this is actually my favorite because it's so simple. It just shows revenue and earnings. And it looks like for the past 8 years or so, they've done really well. They've been growing revenues every single year. They've been growing earnings every single year. And I didn't have time to figure out what kind of acquisition they made in 2020. Oh, I think, didn't they merge with like TD Ameritrade or something like that? And it maybe went into effect here. Because you can clearly tell by the figures and financial. Somebody put in the comments down below who they merged with. I think it was TD. But you can see how, they doubled basically their revenue overnight. And that only happens during like mergers. They swallowed somebody. So anyways, with that acquisition, there come a lot of efficiencies because you only need half the staff now to operate twice as much of a portfolio. So the efficiency is huge. The overhead reduction is enormous. Right? A lot of people are going home and looking for jobs elsewhere. And they get to read the benefits and the technology and the culture from the new company. So as long as there is a good mix, right, it works out just fine. All right. So that's the revenue tab. It's growing. It looks fantastic. Let's take a look at operating income. Well, all the graphs are really going to look very similar because of the nature of this company. Because it's a bank, right? So they just skim a little bit off the top. They collect some interest. They collect this. They collect that. And so the revenue is really correlated with their earnings. They're not just a bank, by the way. They're a financial conglomerate, more like a JP Morgan. Okay, they offer all kinds of services. They're not very one-dimensional at all, right? They offer asset management, advisory services. They have ETFs. They have banking services. They make loans. They do all kinds of stuff. All kinds of stuff. And I'll show you something, by the way, on their quarterly report that you might find really interesting to further solidify my analogy with Robinhood. Okay, but let's wait for that to come. Shares outstanding probably also looks similar. Obviously, they had to issue some shares in order to make the merger work. Dividend per share, they had a one-time dividend at the end of 2022, it looks like. I'm not a stockholder, so a lot of this data is when I'm looking at it for the first time, but many people make a mistake here, right? They're like, oh, he's looking at it for the first time. He hasn't been following the company for 10 years, doesn't know what's going on. Well, yes, I do, because it's right there in the numbers. The numbers don't lie, all right? So you can tell me this and that, and like, oh, he got a sore foot, and so he couldn't come to the meeting, and then he got sued by so-and-so. Yeah, and every single piece of data is reflected in numbers. Kind of like every single piece of data is reflected basically more or less in the price of something, or at least that's the idea. So the numbers tell me a lot. Like, I don't need to know the details of the story, so don't make that mistake. One thing I like about this company here is the profit margin. Okay, the profit margin is around 30% right now, which is much higher. Well, not much higher, but it's higher than most financial institutions. So I think that's a very big plus for the company, and it looks very strong on their numbers here. EBIT probably looks similar, yeah. Okay, on to the statistics. First thing you'll notice, the enterprise value is lower than the market cap. I love to see that. What that means is that net cash is positive for the company. So the cash and cash equivalents and all those, cash assets, there are many different classifications of it. Accounting is complicated. Is more than the cash they have to pay out than their liability side. So it's not quite assets versus liabilities, but net cash, it's like cash versus debt basically. So that means it's positive. So if we scroll down quickly onto the shortened balance sheet, you'll figure out, figure out and see that the net cash position is $7.51 billion with a B, which is not bad. Many banks like to operate in a debt, and that used to be very modern and vogue and cool when interest rates were really low and the cash was flowing freely. But nowadays, it's actually paying, literally, to hold a lot of cash on your books. So, some of the other metrics here that I really like for this company is the price to earnings. Obviously, the price to free cash flow is 11.15, which is great. But since the company has a lot of cash in its books, it's better to actually look at the EV, okay? The enterprise value over free cash flow, which is only 10.21. And its EV to earnings is 11.77. So that's really, really, really good, especially for a high quality business like this. And I call it high quality because it doesn't have slip up years, really. It runs very efficiently with only 35,000 employees, which is not bad for a large financial institution. The profit margins are quite big, so I call them quality because of that. And they have a history of paying dividends even in huge turmoil like the 2020. So if you look at the dividend tab, you'll see that the payout ratio is quite low at 30, especially for a 2% dividend. That's not bad at all. And they have a ever increasing dividend more or less, except with the exception of that one big payout. I'm guessing as leftover capital from the merger. So great health, great performance over the years through tumultuous times. And now they're showing quite a bit of strength coming out of all this. They've been marked down with the rest of the bank. And the question now is that marking down fair? Like, is this actually a big concern? Is the inverted yields a concern for Charles Schwab? To get that answer, we're going straight into the quarterly report. And this is what we get. One second here. This is what we get. Oh, you can't really see. Let me... well, I'm actually going to zoom in instead of zooming out. And I'll tell you what these are. Because I want you to be able to see this. If you're like on the phone or something, you need to be able to see this. So basically the top half is interest earning assets. Okay? The bottom half is funding sources. Okay? So after that big thick line basically. And there's a few lines that I want you to take a look at. First, the first three lines are basically cash and receivables. All right. Now, this is the change from 2023 versus 2022 on the right. And you will see that the average yield rate has skyrocketed when it comes to the cash that they're holding, the cash equivalents. So from an average yield rate from 0.19 in 2012 to 4.46, enormous difference in yield that they're collecting. Then it's cash investments segregated. 0.11 versus 4.31. So they're collecting a ton more interest than before, than last year at the same time. Look at this one. Okay, they have 60 million. I'm sorry, 60. Is this in millions? It should be. It should be in millions. So 60 million here in cash and cash investments, right? I'm sorry, I have to get this right. This doesn't look right. The following table presents net interest revenue from each corresponding total interest earnings, assets, and funding sources. Millions, except, okay, so tabular amounts in millions. All right. So this is how much they're getting basically in millions. These two lines is what you want to look at, okay? You see where it says 155 million, 791. I'm sorry, so that's billions, right? 155 billions because of the comma. That's why I'm sorry, I'm tired. Okay, so yes, these are in millions, but this is 37 billion, 40 billion, 60 billion because they have a comma and then 3 more figures after that. So available for sale securities. This is the big number that you got to look at. $155 billion, and they're collecting an interest of 825 million from that, or 2.12% on average, versus only 1.33 on average before. So these are available for sale. They can use that funds to be liquidated and to appease all of their financial needs if there were to be like massive withdrawals or demand deposits or whatever, or loans that they have to patch up holes in their systems, and they can always draw from that well. This is the well that they can't draw from. The $171 billion, which they're collecting a little bit less interest on, and they have locked up for a long period of time, not collecting much interest at all, and probably money that's withering away to inflation. So that's their held to maturity securities. That's their problem there. And I want to come back and talk to that a little bit. And then they have bank loans that are about 4% collecting. And down below, so total interest earning assets is $504 billion. An average rate of 3.19 versus 1.47 last year, same time. Their interest revenue has doubled almost, from 2 billion to 4 billion in last year. So that's quite a bit, a very large difference. Funding sources, bank deposits is this big number here, an absolute steal, right? Absolute steal. Why? Because average yield rate last year was 0.01%, and this year only 0.73. So they're not paying much for these large sum of money, 343 billion. They're not paying any interest on that, really, relative to where rates are right now. This 77 billion is only costing them 0.39. So payables to brokerage clients. So they're ripping people off a little bit. But it's understandable because, it's transition. Yields skyrocketed quite high. So people are trying to adjust and figure out where exactly they need to be putting their clients at. And then other short-term borrowings, small figure, irrelevant. And then we have Federal Home Loan Bank borrowing and long-term debt, the last two items. So the Federal Home Loan Bank borrowings are a little bit high, about the overnight rate at the moment. So that's kind of like the biggest expense. It's nowhere near as bad as when I looked at banks like Citi, where they had some debt that they were on the hook for that's like 7.5% or something like that, trying to raise some extra cash. I think that's what they were doing, but it's not worth it. It's not worth it. So this isn't too bad, One of the questions that we can answer from this point forward is whether the bank's going to be in trouble. And I don't think it will, because they have just as many assets available for sale as they have locked up, and they're going to be able to meet any kind of demand. The one thing that does bring a little bit of pause for me is that they have so many still, even though they don't need them, they have a lot of assets that are locked up at very low rates for a very long time. And if rates stay high for a long period of time, which they could, then they're really missing out on all of this interest with like a third of their balance sheet. So, investing is also about missed opportunity, right? I mean, if you just sit in a cash and you collect a certain percentage per year, you could be collecting more percent. So you're going to be losing money, basically lost opportunity, even if it doesn't show up numerically, right? It might show up in real terms where you're losing to inflation when you're only collecting 1 or 2% on your holdings. So nominally, they might be doing fine, not numerally. I could speak. I know English. But inflation adjusted in real terms, they might be losing a lot of purchasing power, a lot of value. Okay, so what do we got next? We talked about financial valuation. We talked about risks. The risk basically is that I think the risk is the time that's going to be spent of them not losing any interest. As far as going bankrupt or anything like that, not being able to meet deposit demands or having some kind of failure, that's not really the risk. That's not the risk for this company. The risk is just not making more than its competitors. You know, the banks that are going to rebound the most are the ones that are not on the hook with some of these not for sale deposits, collecting like no interest for 30 years. I don't know what the average duration is. It doesn't necessarily say. I don't think what the average duration is on these holdings. I could probably dig it up somewhere, but it's a big report. So, but one thing I can share is this here. This is what I want to talk about. This is the curveball, okay? Remember in the beginning of the video how I compared Charles Schwab to Robinhood? Well, one of the big flaks that Robinhood's been getting is that they make a lot of their money, a big portion of their money, used to be the vast majority of their money, from order flow. And during the video, I also made a video on Robinhood too, Robinhood markets. During the video, I explained that every broker collects order flow money. It's not like Robinhood's out there to get you and they're the evil company trying to like deceive you into trading or whatever. Look at this. So this is Charles Schwab, right? And look what it says right here. Overflow revenue. This is their overflow revenue. Okay, if you don't believe me, I'll move it so you can see a little. Order flow revenue. You see that on the left? I've highlighted it. Okay. And commissions on top, and then principal transactions. 12% percentage change decrease. So they went from 10% in 2022 being 10% of their interest revenue to 8% of the interest. So it decreased a little bit. But they got 414 million and 470 million last year from order flow. Okay, commissions about the same amount, 8%. I guess they still charge commissions for something. I don't know what. I thought all the stocks went free. Maybe they're charged for options or international stocks. I'm not exactly sure what they're charging commissions for, but nevertheless, they're about equal. Other interesting things. So interest revenue versus interest expense are the top two lines. Okay. Let me move so you can see in the top two lines, interest revenue, interest expense. And, that's increased quite a bit from last year at the same time. So you just look at the amounts, because the percentages can get kind of weird because, interest amount they get and expense portion of that gets canceled out. So you can look at the interest revenue. It's 2.3 and it doubled this year from last time. Factoring out the interest expense, these are the total figures here. So 2 billion versus 2.7 billion. So quite an increase even after the increased expense they've had from the interest that they're collecting. So asset management and administration fees, this is basically their revenue is broken down into the categories, is what we're talking about here. So the next lines here, this is mutual funds, ETFs, and collective trusts, CTFs. 20% Okay, 20% change, or 11% of their total revenues this quarter versus 10% last quarter. So increased a little bit. I'm guessing mostly due to ETF inflows. So their ETF business is growing by 1% per year apparently right now. So 585 million versus 489 million same quarter last year. So this part of the business, the asset management administration fees, is definitely increasing, but are at a slow rate. Okay, 1%. So I wanted to point that out because they're not I don't like the fact that one company is getting vilified over another where the entire industry is doing the same thing. Once something works for one company, they'll all start doing it. They'll pile in and they're like, okay, this is a good idea. Or they see the way that the consumer is going and they want to stop the bleeding of their clients, right? Or there's some kind of political pressure, what have you, and companies adjust. And they have to adjust with the wind, otherwise they'll die off. If they fail to adjust, all their clients will bleed out, and then the company's gone. So they're forced to make moves. They're forced to always compete. And this is exactly what's happening. Now, conclusion. Is Charles Schwab safe? Is it going to catch the illness that the regional banks have started? No, but it might catch a mild cold. And by mild cold, I mean reduced profitability over the long term over what it was before because of a lot of assets being locked at low rates. Some of that may be offset by the increase in interest earnings. So it could be net neutral, okay, these high rates. And it may actually, ironically, provide a little bit of flexibility for the company in case rates do go down. A lot of their asset book will be marked up again in value. So they will grow their assets, even if they lose some of that interest income from the rest of their business. So they might catch a mild cold, but that's about it. Is the valuation good? I think so. Especially for a strong company like this. I showed you some of the strengths of the companies. Their profit margins look great. They don't dilute like crazy for no reason. In a financial institution, they pay a steady dividend. They manage to pay it out in any environment. They tend to survive any environment. And they've made a smart acquisition. They made some good business moves. So the management team is pretty competent. At least they're proving to be so far. It seems to have a very smooth transition and increase in efficiency. So the free cash flow is pretty attractive. The price to free cash flow, EV to free cash flow. There's actually another metric I want to look at here. So when I go to the balance sheet, I want to see this. Let me put some high definition on it by switching to quarterly. Okay, so net cash versus debt. Oh wow, okay. This is crazy, okay. Very interesting. Alright, so I guess they're trying to get net cash neutral. So a lot of times you can tell what they're trying to do by their past. So this company in 2013 and 14, 15, 16, 17, 18, they were holding like around $25 billion in net cash. And then experienced, of course, an increase in 2020, 21. And they're trying to get rid of that in some ways. They're bleeding it, but that bleeding will stop. They will stop it. It looks like they've bought some. Let me double check this real quick. Income. Yeah, it looks like they bought some of their shares back. Some of that cash was used to buy back shares. So in the past like 3 quarters, they've been buying back some shares, and that's probably gonna continue. But it may actually slow down if they feel like they're starting to get into negative cash territory. I doubt they'll want to go negative cash in this kind of environment. But if I'm wrong, then either A, I'm missing something, or B, their management perhaps is not managing things as well as I'm thinking they are. If I'm missing something, please leave it in the comments. Always don't forget that I'm just an investor like you trying to learn his way out here. So if I'm missing something, please let me know in the comments below. And I'll try to add it into my process, into my way of thinking here. Try to correct me. But overall, I really like the valuation. Well, is it like the best deal in the markets right now? I mean, maybe not, but if you know the company, then it could be, right? If you have a really good grasp on what this company is all about, if you have an insight more than the regular person does, and you're confident in its ability to continue its operation successfully, then it is a good buy. It is your number one stock to buy. Like, I remember having this exact situation happen to me with silver miners and gold miners. I had been studying this company called Endeavor Silver, for a very long time. And so when it was time, when the cycle turned in 2015 for the silver mining complex, my number one investment was Endeavor because I knew the company, right? There are many companies that performed much better off the bottom in late 2015 into 2016. However, I knew this company the best, and I felt the most confident to ride out some gains in it, and I did, and that was great. So if Charles Schwab is the company that you know the best, and you're confident that's in their ability to benefit from different market situations, then that would be actually your number one investment. It's not mine, because obviously, as you can see, I'm not abreast in a lot of their history and a lot of their operations, but it doesn't prevent me from having an opinion on it based on what the data says out there and what they publish out in public through my lens. So that's my opinion on Charles Schwab. I think it's valued well. I don't see much risks in their balance sheet besides, decreased earnings for some time. They may or may not be offset anyways. And if I was very familiar with the company, it would be my number one buy. But since I am not the most familiar with the company, I'll leave it up to you to make that decision. All right, that said, mic drop.